welcome to Flip Capital UK's second webinar of the year. Today we'll be discussing central bank policy and its impact on the financial markets with Wayne Bishop, a ethical fund manager for King Shaxson, who has over 25 years experience in the financial sector and is currently responsible for around 60 million AUM. Thanks for joining us today, Wayne.
You're welcome, Andy.
Thank you. Throughout the webinar, the question box is available on the right-hand side of your screen. So if you have any questions, please reach out to our support team, who will get back to you. Also, just to give you a brief outline of today's webinar, we'll be discussing the US Federal Reserve, looking at the challenges ahead for Jerome Powell, before moving on to the super dove Draghi and the ECB, and finally concluding on the Bank of England. Right, so let's get started. So, with Jerome Powell being sworn in just a few weeks back, how do you think he can turn around the fortunes of the dollar? We're just going to pull up the dollar-yen graph now for you guys at home.
Obviously, a lot of things in America are right now a big mix between politics and economics. So we've had the big tax changes, which have really brought in a large stimulus to the US economy. And what this does is it's very clear to everyone that the US economy is on the up and that the economy is going to grow and it is going to grow well. And to a large extent, we are quite clear on the course of US rates. There was perhaps a little bit of an increase in the expectations about the size of the tax package. We're now, if you were reading today the Wall Street Journal, for example, we're now debating whether you're going to have 3 hikes this year or 4 hikes this year, and whether you've got 2 hikes next year, which means you're looking at US dollar short rates ending up sort of 2.75 to 3%. At some stage this year, with inflation, that could go. You could actually start getting positive yields out of the US. The thing is that this is all very much in the market. We know about this, and the debate really is on the fine points of 3 or 4 this year. Really, the problem with the dollar is we know exactly what's happening in America. What is a little bit more difficult is Europe and Japan, obviously the 2 other big counterweight currencies, where we're a little bit uncertain there. So really, the fate of the US dollar, there isn't a great deal that Powell can do. He could talk a little bit more hawkishly. The problem with talking more hawkishly is that people are also beginning to price in the time that there will be a recession. Partly by nature of tax reforms is it's a big boost now and it's a cost later, and therefore people are beginning to worry that yes, we're doing well now, but then in 2020 we might start seeing a recession. Therefore, you might start seeing people price in sinking rates really from 2020. So it's going to be a bit counterproductive for him to get too hawkish, but at the same time, really now we need to see something out of Europe, we need to see something out of Japan to really understand the course of their economy, because they, I think, is going to have a bigger impact on the dollar than the US alone.
Thank you, Wayne. You hinted in your answer there about inflation. Speaking about inflation, the core PCE remains persistently below target. Do you see this improving in either the short or long term? And on that, how do you see the recent slump in oil affecting this? We're going to bring up an oil graph for you guys now.
Okay, well, yeah, core PCE is really quite a big problem here, because the oil price, I think, is naturally going to be capped because of the growth of shale. This has been such a game changer. I think people are really still only getting to grips with this. If the price rises, America just turns on more and more tax. And therefore, really, despite every effort to get a high price, and I think there has been an effort, particularly with the flotation of Saudi Aramco coming up, to raise the oil price again. Every time it rallies, I think you'll start to see increased supply and it will start to come down. And of course, we're talking about peak oil in the longer term. So I think the core number is quite difficult. The other aspect of core, of course, is food. And if you look at the charts out the wheat chart or the corn charts recently, food prices have been under a lot of pressure as well. So you've had years and years and years of bumper harvest. So you're not seeing any pressure in food, you're not seeing any pressure in oil. And therefore, I think the core is going to find it very difficult to rise. That said, we did have an oil price, we did see quite a sharp rise in oil last year. That's obviously fed through into the core numbers, but should now start to feed through into non-core numbers. What do I mean by that? Well, anything that, anything directly affected by oil obviously is a direct impact, is in the core number, or is in the core number. Anything that basically then is a follow-on effect of the increase in food prices, the increase in delivery costs, because the oil price gets reflected through into the raw material costs, then sort of seeps its way into inflation. So at the moment we're seeing that remain reasonably firm because we had the higher oil price last year. As we get a sinking oil price again, you may see that come under pressure as well. I don't think inflation is really going to be a driving force in America. If it does, it's going to have to come through the form of wages, and that is possibly about the only place where you're going to see inflationary pressures begin to build up. But again, I think there's increases in productivity. So inflation to me is not going to be a huge problem in America.
Thanks, Wayne. Moving on, the US stocks experienced sharp slumps recently, with the Dow Jones losing over 1,000 points in a day. Do you believe that the equity sell-off heightened on increasing concerns that inflation will push interest rates higher, or not?
I think that was very much the go-to excuse or the go-to reason when people were looking for a reason why did the US market collapse so rapidly. I think it was really an afterthought or a reason, really. I think the main problem you had with the US market was that really it went far too high in January. It was driven hard, particularly by ETF and index-linked products and leverage products. And then immediately, the moment there was no demand, there was nothing left, and it came down. You've had one of the biggest problems with the change in regulation over, say, the last 10 years that people are still getting to grips with. Banks' balance sheets have been shrunk, their trading books are shrunk, so therefore the banks are able to be less of a shock absorber when markets move because dealers don't have as much to play with or as much to use. At the same time, the end investor has access to highly liquid and highly leveraged products that they never had access to before. Therefore, the end user can drive the market much more rapidly up and down, and there is less of a shock absorber now in the market end of liquidity to absorb it. And I think what we saw there was a classic case of everybody going up at the same time, everybody trying to find the exit at the same time, and going up a hill and down a cliff very rapidly. In the big picture, of course, it's really been nothing more than a storm in a teacup, but I would expect more volatile days like this to come. But I think we were just searching for excuses when we were trying to say it was about interest rates. Yes, rising bond yields have become a concern, but really these numbers are not massive in the big picture. I think this was more about liquidity.
Okay. Last time out, you predicted that Trump would do something on fiscal policy, with you suggesting it may not be to everyone's liking. With Trump's sweeping tax reform now coming into effect, how do you see this materialising? And do you believe this will be positive or a negative for the Fed?
Forgive me, sorry. There's definitely a big psychological effect with these tax reforms, and there's also a very big technical effect with the tax reforms. And these are both going to boost GDP or growth in the short term. What do I mean? Well, everybody feels better, and what we've seen is companies sending money out of their balance sheets into mainstream. A lot of these tax cuts are being sent to employees directly. They're able to consume, reduce debt, or do something with it, which I think is a big positive. The other thing, of course, is that more companies will now be routing their sales through America rather than through Ireland or the Netherlands or Luxembourg, for example. So it's going to make US productivity or US GDP look a lot better without actually changing anything, because it's actually going to be technical. So you're going to see a technical improvement, you're going to see a psychological improvement, and I think for the next 12 months, this is going to be quite significant. Things are going to look very good. And I do think that there's a bit of timing here in the midterm elections. After that, the bill comes, and I think we'll start to see, what a lot of people have been saying, oh, it's bad really in the long term. Some of that truth will start to come to bear. The question is whether the US economy is picked up sufficiently in the short term that people don't really mind in a year's time or aren't bothered, or whether in a year's time we're going to start to see a bit of a slump. But the fact of the matter is, it's had a very good short-term effect, and I think that's quite a strong short-term effect. And that's going to drive the market well. So I think he's done a very good political job. Whether people like him or not, that's beside the point. Politically, he's been quite shrewd with these moves here. The bill comes next year, and I think the hope, if you like, for those looking for a stronger US economy is that by the time the bill comes, people are too happy to care or pay the bill.
Yeah.
And I think he may just get away with it.
Yeah, so sort of a clever move there by Trump with a view to the midterms. Right, finally on the Fed, how do you see the Federal Reserve's proposed rate hikes playing out? Market analysts are predicting between sort of 3 and 4 hikes this year. Do you preempt any issues with this already being priced into the market, or is that sort of to be expected?
Yeah, the exciting discussion is it going to be 3 or is it going to be 4 this year? I think at the moment, with the strength increasing, they would probably try to get away with 4 rather than 3. But again, it is already to a large extent priced in. And if we do suddenly look like we're going to head to 4, then also we'll start saying 5. I think we still feel the end game is sort of round about the 3% area. The big other that's going on in the background, of course, that's really sort of gone very quiet is the Fed is still reducing its balance sheet. And obviously, at the moment, we haven't really seen many effects. We know about it, it's happening, it's going on in the background. Slowly, that will begin to bite more and more, perhaps into the second half of this year and into next year, we'll start to see some effects on that. So I think there may be room for more caution, but at the moment, I think the course is well telegraphed. I think markets are really in a very luxurious position of having every slightest detail telegraphed very, very clearly. So I don't see any particular reason for them to change that. If we do suddenly find that we're a little bit quicker on the hikes and suddenly some people start jumping about 5, we may see a little bit of nervousness in the market. But I genuinely feel I think 4 is pretty well priced in and people are comfortable with that.
Moving on from the Fed, as we were speaking about rate hikes, when do you see the ECB raising its base rates above 0%, especially with a stronger euro and increasingly positive economic data in that Eurozone?
I think Draghi doesn't want to go out in history when he leaves the ECB into next year as being the man who's been a serial easer. And therefore, I do think he may want to start to change the course of rates. The biggest problem you have is, and I think the most important thing to remember is, Europe is doing well, it is playing catch up. It is benefiting a lot from the growth around the rest of the world. And although at the moment it may be a very popular place and people are saying here things are looking wonderful, it is still quite a diverse economy. It hasn't had any of the deep reforms that are necessary for longer term growth. And really it is really the rising tide lifting all boats scenario at the moment. Saying that, I think it will continue to continue to benefit from the strengthening global economy, and we'll continue to see good headlines certainly coming out of it. What do I think about the actual timing? I think it's still going to be further down the line than we think. I think the thing you have is you've got to look that inflation is different in European countries. I think we've got the graph up at the moment, the difference between German CPI and Spanish CPI. We still have a divided Europe. We have a Europe where you have strong northern growth going on at the moment, particularly say around the German economy, although there's a lot of political uncertainty there, the Nordic economies, and you still have high unemployment in France, Italy and Spain. And I know France are very proud that their unemployment's fallen below 10%, but that is still, in the big picture, pretty disgraceful. And there still needs to be a lot of work done. So I'm a bit wary about getting caught up in this sort of pro-Europe trap at the moment. Yes, we want to see them do well, we want to see this growth, but I think the growth story is not as strong as people make it out to be, and the need for rate rises in some parts of Europe is strong, but in some parts of Europe is not there yet. I think we'll be definitely to the second half before anything actually really happens. There will be a lot of talk, but I think we're still a long way off a rate hike as such.
Yes, and do you think that Draghi would be happy to sort of forego his own personal agenda in terms of not being seen as someone who's stayed at 0%, or do you feel he might move for his own benefit to come over as a little bit more hawkish, or
I think he'll want to leave a good legacy for his follower or whoever gets a job after him. I think he's been seen by many as the saviour of Europe, from the famous speech and the famous comment many years ago about doing whatever it takes. And I think he's leaving Europe in a strong position. So I think he'll be keen to keep that. And yes, whether or not he wants to just at least turn it just before he goes out. I've done more than just these. I think that's a marginal point, to be honest. I think the real thing for him is leaving the economy in a strong position.
Yes. How do you perceive the recent move by the ECB to halve their tapering programme, I believe, down from 60 billion to 30 billion? Is this a sign that the ECB is finally moving away from its arguably overtly dovish policies?
Yes, I do, and I think the problem is that we're getting to situations where you're running out of paper to buy as well. It's been a huge distortion of the market, and increasingly out of touch as America begins to reduce its balance sheet. UK is static. Japan's Japan. It's been at it for a long time. It's a different story, really. So they were looking increasingly out of place. It was politically divisive. And to be honest, I think the effects were becoming more negative than positive, particularly to the European banking system. So yes, it's a good step in the right direction. It would be ideal if they can actually start to bring that to an end. I think, like nobody, don't want to rock the boat. Yeah. And as I said, there are parts of Europe that are still very vulnerable, and they're the parts of Europe that are also politically quite important now. Make particular reference to Italy coming up with the elections.
Yes.
And therefore, I think until we probably get past those points, I don't think it wants to look much more than it has done now.
That makes sense. You've previously suggested that reform is needed on the Eurozone's fiscal policy. With the EU's budget reportedly being 14 billion euros a year worse off post-Brexit, how do you see the EU coping once Britain finally exits the EU fiscal cycle? How concerned do you think the ECB are on this?
At the end of the day, these issues have got to be addressed, and it's not just it's both the European Union itself and the individual countries that we've got to come off, mass bond issuance and using bonds as magic wands. Yes, the European budget is going to be very divisive. They've lost a major contributor, and as perhaps we're seeing with the way they're dealing with Poland and Hungary, there's perhaps a little bit more politicalisation around some of the restructuring and reform budgets that are going to be sort of set in the next year or so, particularly threatening Poland with the fact that they'll get less of the sort of redistribution or the infrastructure funds for the future. And the need is not as great as it was. Eastern European infrastructure has improved dramatically to what it was back 20 years ago. So the need's not as strong. So yes, there's got to be some serious soul searching of what matters and what doesn't matter. And unfortunately with Europe, as you know, it is far too political for its own good, and there's going to be a lot of log rolling and a lot of, shall we say, poor decisions made for political expedience rather than actually for the greater good. So it's going to be a difficult process. The ECB are going to need to keep an eye on this as well, because as they stop buying, other people are going to have to step in and start wanting to buy bonds in a world where bonds are nowhere near as attractive as they used to be. People will always go for the quality, and there'll be low quality bonds that suffer again. Therefore, this is going to be a tricky game for them in the second half of this year.
On that subject, we saw earlier this week reports out that the UK may withhold their sort of financial settlements to the EU when exiting the EU if they fail to agree sort of a trade agreement, and that continues how they expect it to. Do you think that's more sort of smoke and mirrors from the UK, or do you think they actually would withhold the financial settlement against the EU if they fail to actually go ahead with the trade agreement?
No, I think it's a very real threat. I think UK politics is just in a very awkward place where you have a prime minister whose biggest enemy is her own government, or her own party, and a very divisive debate on Brexit, because it split the country right in half, continues to split the country. And to be perfectly honest, perhaps the way the whole Brexit thing was initially sort of described was we were very weak, Europe was very strong, we're going to have to do, to actually realising this is a partnership battle. and therefore actually we do have some strengths. And yes, we do have the ability to withhold those funds if we don't get the deal we want. And I think it's a very real threat. I think it's something we will use. What do I actually believe will happen? I think at the end of the day there will be some very decent settlements because it's in everybody's interest. Europe doesn't want to lose a massive export market. We really don't want to lose a large export market. Trade is good in the big picture. And as always, this is going to take to the 11th hour, 59th minute, 59th second if we don't go over. So really, we have to take seriously what's said here. But I think what's happening is people are realising these battles are, people are not listening to the rubbish anymore and beginning to sort of look at what could really happen, rather than the panic stories and the constant drivel that we've really had suffered so much from over the last sort of 12 months. And we are going to see some hard facts, and we're going to see some hard dealing. So get prepared for all kinds of headlines, really, and all kinds of threats. But I think ultimately, pragmatism will succeed.
Yes. Moving on from there, last time we spoke extensively about the German election. With the Grand Coalition now set to continue with Merkel's Conservative Union bloc and the Social Democrats. However, with the far-right AfD party gaining in popularity, how do you think Merkel can begin to regain support amongst the German public? Is immigration still the main sticking point? I know we do have the vote on the 4th of March to actually decide whether the SDP and Merkel's Conservatives do eventually agree, but from what we've seen in the media so far, it does seem that that will go ahead.
Well, the AfD's perhaps a little bit of a red herring. What's really happened in Germany is you've gone from a three-party system in the 70s, a four-party system in the 80s, to what is now really a 6-7-party system. And it's getting very, very difficult with this fractured sort of German political scene, 700 seats divided by 7 parties, to try and create a workable coalition. And at the same time, Merkel has lost her shine. I genuinely believe it was a big mistake her not standing down before the election and putting someone younger in. I've also been quite disappointed that so far her response of bringing young blood in is to bring a 50-year-old in from the Saarland. I know she was a very successful politician, but really they should have been able to be younger than that and really try to really modernise the party. So we do have this very difficult situation. We have the SPD, who are now at their lowest ever in terms of opinion polls. They had a pretty disastrous election. They're down into the high teens in terms of now how they stand in opinion polls. They've lost support with this whole Grand Coalition talk. And of course, yes, we have the young socialists, Kevin Kühner, leading a very, very vocal campaign, having gained a lot of members as well in the process, to try and vote this down. And the 4th of March cannot be regarded as a foregone conclusion. Yes, 70% probability, 75% probability that it'll go through, but there could be a spanner in the works here. And if that is, then we're going to have to look at either a minority government and possibly a failure of this Bundestag, and then basically new German elections. But the problem is those new German elections aren't really going to produce a wonderful result. What can Merkel do to revive the party? My own opinion is there needs to be a whole new wave of young blood in the party and new kind of leadership, because I think a lot of the problem in Germany has been young people have found their voice. They found it on the right with the AfD, they found it on the left with the USOS and what they're doing here with Kevin Kühner. And these are the people who are not, as in a lot of Europe, these people have not seen the benefits of the growth. They've not seen they've not seen their jobs improve. They've not seen their lots improve. And these are the guys who are really sort of say the neglected voters and the angry voters. So the German political system is going to have to respond to this. And so I think Merkel and that lot, I think they really need to think very hard about whether they should accept their own publicity that Europe wants the stability that they offer, or whether actually Europe is saying we've got something a little bit more modern there.
Yeah. The ECB has begun the process of board changes. Earlier this week, we saw the appointment of new Vice President Louis de Guindos, with 2/3 of the central bank's 6 members set apart. during the next 2 years. How do you see this affecting the Eurozone? And are there any early indication on who will replace Draghi himself?
Yes, obviously, again, very, very expedient European politics. We saw Ireland put up a candidate and then withdraw at the last minute, just to ensure that we got the vice president in. I think some people have felt there's been something offered in return. I think the chief economist job, I think, is the one that people are talking about there. So, and unfortunately, the most frustrating thing with Europe is that it's about politics and doing what's politically expedient rather than choosing the right people. And therefore, when it comes around to who's going to take over the ECB at the end of Draghi's term, well, we've got the Germans pushing very hard. They paid the price of having the ECB in Frankfurt was that they weren't going to lead it for the first 2 or 3 goes. We've gone through a Dutchman, a Frenchman, we've gone through Draghi, and now I think they're quite keen to have their turn. But of course, the problem is their stance would be incredibly different, a lot more hawkish than, say, getting someone else in. The French are feeling quite resurgent with the German political hiatus. Macron on a bit of a roll. I think they're feeling that they may push something a little bit harder. It may not be another Frenchman. We've already had Trichet, but they may try. They may try for some of their favourite people. So I think there's going to be quite a little bit of. It's going to be a little bit more of a battle than people thought. So yes, the problem is really what you really want is the best person for the job. In there, really the best central banker you could find. One of the European, we've tried it in the UK.
Yeah.
They need to find someone who is going to manage to hold together a very diverse continent, a very diverse sort of economic structure, in a very political way, and that's going to be a tough call, because at some stage the issues of the debt have got to be addressed. And really, the timing is going to be there. At the same time, we've had obviously a few political scandals arising in a couple of European central bankers as well, which doesn't help.
Definitely not.
It doesn't help with credibility. I'm not particularly anti-European. I think these things will work, but I think we have got to get to a point where they've actually got to make some right decisions for the continent, and not for whatever political expedience they want at that particular time.
Yeah. Finally, on the ECB, we did hint on it earlier. Inflation remains an issue within the bloc, below target about 1.3%. The downbeat forecast, averaging 1.7% by 2020, remains under the 2% inflation target. How do you think the ECB can improve upon this? We can put up the graph again for Spain and Germany, just to give us a bit of an indication on inflation in the Eurozone.
I think again, there's very little the ECB itself can do here. They're throwing the monetary kitchen sink at this whole situation. They're throwing everything they can at it. It's restored confidence and it's given them a basis to work on. But you've actually got to start to see genuine economic growth, and that economic growth has got to be for the economy. As I say, Europe is the host of some fantastic European companies, but they don't necessarily make their money in Europe. They are great global companies. You can look at Daimler in Germany, Siemens in Germany, as sort of 2 big examples. The European economy still needs to benefit the man in the street, and this is where I think you've got to see that effect before you start to see re-inflationary pressures. Otherwise, inflation is going to have to come from global demand outside of Europe on a cost-push basis. And I think that is more likely to happen. In other words, you're going to see the rest of the world improving, you're going to see commodity prices perhaps go higher, and you're going to see inflation coming to Europe that way, which is not the best way for Europe, but I think it's probably more inevitable at the moment. So I think you're going to see a little bit of a rise in inflation. But I don't think you're going to see the 2%. But I don't think that would stop a hawkish governor.
No.
So we need to raise rates. It may stop a dovish one. So we come back to that question of whoever takes over and the framework for Europe after that.
Yes. Unlike the Fed and the ECB, the Bank of England has issues with above target inflation, with this currently standing at 3%. This is tightening the squeeze on consumers as wages remain fairly stagnant. Do you see inflation falling closer to the target 2% level? And what can the Bank of England do to support this?
Yes, the UK is very different. We have obviously given ourselves a fantastic challenge with Brexit that's going to last for another year with huge uncertainty. The shock absorber for that was the currency. Obviously, sterling tanked on the results and has slowly been creeping higher. But this is where the shock has been absorbed. This is where we've seen a lot of the inflation come in because obviously import prices have risen sharply. At the same time, we then did something by raising the minimum wage, which of course has an inflationary effect across a lot of workers. And at the same time, we're seeing things like rates and other sort of government bills rise to compensate for some of the revenue and budget issues we've had. So really, in terms of inflation, the UK has had an awful lot thrown at it over the last 18 months. What that means is I think that really some of these pressures will begin to abate. So we know the course of wages, we know the course of minimum wage at least, and we know the course of national wages. We have got shortages in certain sectors in the UK, partly because of sort of immigration issues that have come around Brexit. And they're the sectors that really matter, particularly around construction, for example, which is a very important part of the UK economy, and I think will be a very important part of what goes on in the next 3 or 4 years, and quite an essential part as well. So we have created a lot of what I would call homegrown inflation problems. But I think we are probably likely to abate, but I don't think we're going to necessarily abate a great deal. So I could see inflation dropping to say 2.5%, maybe 2%, but I cannot see it collapsing in the UK.
Okay. You hinted in the answer there about rates. The Bank of England decided to raise rates for the first time in over 10 years back in November. This does seem to have a fairly positive effect on the UK economy. Do you feel that the Bank of England has got it right with its forecast of a further 2 more rate hikes by 2020? Or do you believe this is an overly cautious approach to their tightening policy?
It's definitely on the side of cautious. With the global economy improving, we are improving alongside the global economy as well. We have got sectors that are doing well, we've got sectors that are suffering, but it doesn't matter how well you do when you have a great deal of uncertainty at the moment. So the UK economy has certainly got a lot of headwinds to contend with, which is why our rate hike expectations are low. Was it the right thing to raise rates back when we did? Yes, I think it was time. The emergency cut was not as necessary as perhaps had been received at the time, but back at the time, nobody knew really what on earth was going to happen. So it was a wise thing to do that. It's been a wise thing to reverse it. And yes, it is at some stage we are going to have to move forward and raise rates. One of the biggest problems we have in the UK companies, of course, we are quite highly leveraged. And although I think a lot of mortgages are sort of have got caps and floors to know perhaps away from this low rates, in other words, when they do raise rates, it will have an effect on some people's mortgages, but not necessarily on everybody's mortgages because we have these caps and floors. But it will start to set and change the tone slightly. So we are going to have to be a lot more cautious about raising rates while we have all this uncertainty. So yes, it's probably the more cautious position that we'll get to. I think if we feel a bit stronger, the market will be able to take it a bit stride if we decide it's going to be 3 or 4. But I think that's going to have to come on the backdrop of a much better economic outlook than we have at the moment, and a much more certain economic outlook at the moment. The one thing we do know is that there will be some certainty as we go into 2019. It might not be a good certainty, it might not be a bad certainty. Yeah. We don't know what it's going to be, but at least we know we will know by the time we get to 2019. And then the economy can begin to really make more informed decisions when we get to that point.
Yes, I mean, it seems like the Bank of England are sort of edging on the side of caution with sort of Brexit uncertainty still being there until we sort of actually eventually leave in March next year. Moving on, we've seen significant rises in cable recently, even despite the recent blip. It remains around the $140 mark. Do you believe the improved optimism in sterling is here to stay, or will it come crashing back down once we hit the next major hurdle in Brexit negotiations? We'll just bring up the graph for you guys now.
Well, yeah, you can see from the chart, you can see where things have started to improve, and I think again slightly at the same time, perhaps people came back down to earth a little bit more in America. So you see a very good dynamic there. I still think we're going to have the odd shock headline every now and then. We're going to have a little bit of screaming and shouting, especially if we get close to 2019, and especially as perhaps Europe is a little bit less leaderless at the moment as well. So yes, I do expect the odd little bump, but I think probably the downside is limited. I think we find around the 135.10 area a reasonable level of support there. We may find ourselves pushing there, and I think probably the natural course of gravity will be we will slowly head higher and higher and higher, and I'd say 2-year objective, maybe getting back towards 150 again. So I'm sort of on the whole positive, because I think we will start to get the certainties just by sheer fact, and we will work with them as we get to them, and that should be a good underlying case. I think the case for the UK rates is, although we've only priced into, and I think that's wise at the moment, the potential is, I think, for us to price in more rather than less, and therefore the potential for surprise moves with sterling as well, rather than with the US. So yes, I think probably we will get the odd little bump here and there. I think it will be wise to test supports every now and then, so I wouldn't be surprised if we're pushing down at 138 in the near future. But I think in the trajectory, I think it's still upwards.
Yeah, so long term, we feel it's sort of on the up. Moving forward, do you feel that the loose monetary policy remains a necessity as the cloud of uncertainty looms over the UK because of Brexit? Or do you feel that uncertainty in Brexit has created a systematic cognitive bias within the Bank of England?
No one in the Bank of England wants to get this wrong, because obviously this is historic. These are the kinds of things we'll be telling our grandchildren about, whether they want to hear it or not. They will be getting these stories, and I think the Bank of England really is going to naturally stay and has this cognitive position of being cautious. At the end of the day, if we did get a little bit of runaway inflation, that's a lot better than causing another recession in a difficult time. So I think the natural bias will be to stay loose because of all the uncertainties and all the threats. One you can correct, I think, a little bit easier than the other. And secretly, I still always suspect nobody would mind a little bit of inflation. So certainly with the debt pile we have. So I think that is a natural bias, and I think it is there to stay. Nobody wants to get this wrong, and so we will stick with that because it's the easier of the two messages to unwind.
Yeah. Finally, on the Bank of England, did we see the first signs of a more hawkish tone from the Bank of England on Super Thursday a few weeks back, with them hinting at faster rates of rises as economic forecasts improve?
I think that was a good warning shot. I think that was a good sounding, basically. Whether or not they're actually going to be more hawkish, we must remember Mark is the unreliable boyfriend. I don't think he'll actually become more hawkish, but I think it was a very good shot, and it was very well received by the market, because I think things could be better. We've covered ourselves with so much negativity. Things could actually be better than they seem, and therefore, if they are better than they seem, we will act. So I think it was a very good sounding. It was very well received by the market, or better, reasonably well received by the market, and therefore I think he will probably make the odd sounding that way every now and then. But I think it was a little bit more like that unreliable boyfriend just probing to see what he can get away with, rather than actually a totally policy stance. Because with so much uncertainty, I think that they'd rather stay cautious, but at least they know that if they feel they can step forward, they will step forward.
Yes. So that brings a close to our webinar today. Thank you all for joining us. If you do have any questions regarding what's been discussed in this webinar today, please reach out to our support team. Or if you have any questions on our products or services, please do get in touch. We have another webinar coming up in a few weeks' time. This will be on technical analysis, so keep your eyes peeled for that, and please do sign up. If you haven't done so already, please sign up to a demo account. You can practice your trading strategies on there and familiarise yourself with the products and services that Philip Capital UK have. Also, please look at our website. There's a lot more information about us, about the products we have, about the new promotions that are coming. So, like I said, please have a look on there. Enjoy the rest of your day, and thanks again for watching. Thank you, mate.